SVB Financial Group became the greatest bank failure since the financial crisis of 2008.
In the largest bank failure in the United States since the 2008 global crisis.
This is news that should seriously concern you.
On March 10, Silicon Valley Bank, a lender to some of the biggest names in the technology world, became the largest bank to fail since the 2008 financial crisis. This has sent shockwaves across the tech and banking industries. The bank catered to very specific crowds of startups, venture capitalists, and tech firms before it collapsed. But what led to the collapse of the SVB? We take a look. Before understanding what went wrong at SVB, it is essential to understand the functioning of banks. Basically, a bank accepts deposits from its customers. It then uses the deposits to extend loans to other customers and uses the rest of the money to invest elsewhere. It is done with the assumption that all the depositors will not show up at the bank's door to withdraw their deposits at the same time. Now, like other banks, SVB too had invested the money into safe instruments like bonds. After the 2008 depression, the interest rates in the US were very low. This ensured cheaper loans and VCs invested more and more money into the startups. This in turn benefited the banks like SVB because these startups trusted them with their deposits. However, last year, the US Federal Reserve started hiking the interest rates. From 0.25 to 0.5% in March 2022, the federal fund rate has now been raised to 4.5 to 4.75%. This reduced the returns on bonds. The higher interest rates have also led to a slowdown in startup funding. This reduced the pace of deposits at SVB. On March 8, the bank said it sold $21 billion of securities at a loss of $1.8 billion to ensure liquidity. It was also planning to sell $2.2 billion worth of shares. Moody's downgraded the bank's credit rating. On the same day, Peter Thiel's Founders Fund asked its portfolio companies to pull out their money from SVB. Several VCs followed suit. The SVB was unable to meet such a high demand for withdrawal at such short notice. On March 10, the trading of the bank's stock was halted and the bank tried to sell itself. The regulators stepped in and shut the bank.